You are such an asshole!
Yodel. You can all thank Yodel for this. Yodel, it's summer. Yodel keeps coming up with these. They're not. They really aren't complicated. The questions aren't complicated. They are unnecessarily complex, if that makes any sense. All of economics is very simple. It is. It's just very simple because, frankly, all the stuff that you see happening with the Federal Reserve and central banking, not just the U.S. Federal Reserve, but all the central banks, all it is let's just print off more money. As if we haven't fucking learned that. Apparently we haven't. Apparently through the Chicago School of Wharton and all these other Harvard economists and Goldman Sachs, all these fucking masters and doctorate-laden dipshits still call it, let's just print off more money. And I don't care how complicated they make it, what fancy euphemistic terms they give it, like, ooh, it's a quantitative easing. Is it? No, you're just printing off more money. And you're going to hear some gurgling over there because I have a weird plumbing system in this old house. Anyway, so Yodel, what did Yodel ask? Oh, you bastard, Yodel. Hello again, Captain. Unfortunately, I have another economics type question for you. I know you hate me right now, don't you? I have posted some videos below. Take a look at them and answer the following questions if interested in the request. I don't know if you heard of Econ Matters, but I find some of his blog posts on Zero Hedge, YouTube videos, and his website interesting. In your opinion, do you think the bond market in the U.S. and held globally, as in the EU, Japan, etc., is in a bubbly state? Is this the next potential big short? If so, how can one profit from this? Can one use inverse ETFs to short bonds? Like the and then he lists a bunch of different ticker symbols for the various ETFs out there that are bond ETFs. And if you don't know what an ETF, that means exchange traded fund. It's just it's a different type of mutual fund. That's all it is. So it's just a grouping of different bonds. Just like a mutual fund is a grouping of different stocks or bonds or both. Or other to short currencies like the euro. Okay, so can we make money when the price of these things go down, which is called shorting? That's how you put a bet, essentially. I have a video on what exactly is short selling. You can look through it, but you make money when prices go down. I think these inverse ETFs compound daily and can actually have some drift from the respective index they are supposed to track over time. I guess compounding works for you and against you. I think you mean leverage. There's compounding, which is exponential, like your annual rates of return. Maybe inverse ETFs can be a double-edged sword. Maybe directly shorting the actual bonds, like another ticker symbol is better. Well, let's answer your, can you short it? Yes, everything that you just listed you can do. And I think let's kind of clear up another technicality is, for example, bonds are typically very boring. They're not highly volatile, especially government bonds. And then also currencies. Stable currencies are not terribly, they don't fluctuate a lot. So, you're talking, you'd be excited if there's a 1% change in government bonds and a 1% change in currencies in a day. So what people do is they will use leverage. They will borrow millions, billions of dollars and take a position to have a small equity portion, but any profit they make using that capital to leverage the rates of return, they can get 50-60%. Matter of fact, if you have a currency exchange account, which I had, you can't just trade straight 1-to-1. You have to have some kind of leverage. And I remember, I think the lowest was 10-to-1. I think the highest was 500-to-1. So you'd say, boy, that sounds really risky. Yes, but you can only trade in certain currency pairs, which means stable. Well, not that, but the currencies that you could trade in were stable currencies like the euro, the US dollar, and the yen, and stuff like that. Anyway, to extract higher rates of return, you can use leverage and debt to exacerbate these returns. Or they have, as you mentioned before, there's already these leveraged ETFs out there, leveraged mutual funds, that already do the compounding or the leveraging for you. So yes, everything you mentioned is fine. You could do it, talk to a broker or a currency trader. They'll take care of you there. I mean, you're going to pay, but you have to pay for a commission anyway. So everything you've listed, yes, you can make money on these things if they short. Now to get back to your question, in your opinion, do you think the bond market in the U.S. and held globally is in a bubbly state and is the potential next big short? All right, so here's where we got to do our economics. Is it bubbly? Hell yes, absolutely. And this is more than evidenced by what we have as negative interest rates, where it's like, you give us the money and you pay us to store it. And this is the world of negative interest rates, and the reason negative interest rates exist is because there is such a lack of growth, and there's so much debt, and there's such a fear out there, that people are not chasing after rates of return, they are chasing after capital preservation. I mean, they don't want to lose their money. They're fine with stability. And this is actually kind of what it was back in the olden days. Like in the olden days, I mean goldsmith, silversmith. The goldsmith, I don't want to get too much into the history of money, he was kind of like the bank, you know, and you'd say, oh, I'd like to store my gold. And I could store it at home, in which case the bandits can get it. I don't really have safe ways to store it. Or I could store it with the goldsmith who has like locks and metal boxes and things, and he you know, he's armed and he's got guards. So I'm going to store it with the goldsmith. But the goldsmith's like, dude, you want me to watch over your gold, put my life at risk? Dude, I'm going to charge you. So and I'm going to charge you a percentage of your gold every month, year, whatever. So they were providing you a safety service to storage, just no different than a storage facility, like, you know, for all the crap that your female girlfriends buy. I like doilies. I bought 1,000 of them. No, we can't sell them. We have to store them somewhere. Anyway, so that's kind of what's happening now, but on kind of international, global, central banking, way above macroeconomic scale. Not you and me. Gosh, I got some silver. I'd like to store it somewhere. We're not talking about that. We're talking about hedge funds, pensions, and government saying, oh shit, where are we going to store it? Now, because of all the debt and slowing Western economic growth, not to mention China and India, growth is slowing down. But where do we park our money? Where do we park our money? This introduces the world of the world's reserve currency, where people go to safety. And since World War II, the United States has been the world's reserve currency because we're the United States and we are just safe. Because why? Because we've always been. Even though our finances and fundamentals fucking suck. But the sad thing is that our finances and fundamentals suck less than pretty much everybody else's, which is why, it's a great video if you want to watch it, why hasn't the economy collapsed yet? That's another video I put together. But basically, why we have slowing economic growth, tons of debt, a lazy, if not outright parasitic population. I don't know if you notice all the immigrants and the millennials, and you know, don't just think it's immigrants. It's the home team too. All these liberal arts majors. Nobody's producing any stuff. We're borrowing and spending, and we're basically, as an individual, borrowing and pissing away our money on shit that doesn't have a rate of return. We're never going to be able to pay it back. And you can see this. I love how the Democrats and the left and the Labor Party, they always say, we're investing. No, you're pissing it away on welfare bums who don't fucking provide a rate of return. We're investing in education. No, you're pissing it away on a bunch of dipshit liberal arts majors like that Zachariah Fareed and all these con artists posing as humanities professors. You're not going to get a rate of return. You're still going to sling coffee with your doctorate in lesbo, polygamy, architecture, sculptural studies of the 15th century. So there is no rate of return. But people really aren't concerned about rates of return. They're looking for safety. And right now, the U.S., no matter how bad our fundamentals, no matter how truly fucked we are, no matter how much me as a credit analyst, if I was in banking, I'd look at the United States as a potential borrower, I'd be like, fuck you, get out of here. Much as bad as that is, we're still the best game in town because, one, it's a psychology. There's no real reason we should be the world's reserve currency. Our fundamentals isn't there, but it's just that we're the least worst of the world, so that makes our currency kind of the best. But the other thing is that we're the largest economy in the world, which means that we actually can produce the economic goods to back up every dollar that's been printed. And I've used this example before. People say, well, why don't we use a very stable currency like the Swiss franc? Well, right, Switzerland has much better finances. Korea has much better finances. There are other currencies out there that are way more stable and better than the United States, the Japanese yen, the yuan, Chinese yuan, all these other large countries that could be potential world reserve currencies. But the problem is with Switzerland or any other, Singapore, they're stable currencies, they got great fundamentals, but they don't have the economic production. They're such small economies. Like if they also print off trillions of dollars in Swiss francs, and everyone started, okay, what if everyone wanted to start buying stuff? Well, Switzerland does not have the economic production capacity to make good all those trillions of Swiss francs they printed off. Now, this brings about an interesting side note, if you just bear with me, a very interesting thing. What I don't understand is if Switzerland, if you have a small little country with a small, very stable currency and it starts appreciating, why don't you just print off a shit ton of that and just start buying foreign countries' assets and then invest, like real investments. Don't invest money in the fucking losers, okay? No welfare, none of that. Like, you actually buy assets. Like, Switzerland should be buying, I don't know, Google or buying Apple or something like with their over. But that's just an aside. I don't know why they do that, but they don't. They always try to deflate their currency so they can export. We got to export. It's like, no. Go on an acquisition rampage. Go be a fucking Viking and go rape and pillage the world's assets. It's productive assets. Anyway, where's it going? So, but that's why the U.S. it's kind of like a deep and wide enough economy that we will still produce the $16 trillion in GDP. That if you have a dollar, chances are you'll probably get some kind of purchasing power out of it, no matter how much we flood the global economy with our dollars. Now, all that being said, there is a little bit of risk. Like, it's not like people aren't aware that the United States has nothing but becoming a welfare state and that we're a bunch of lazy fucks. And we're importing a bunch of lazy fucks. So people the foreign investors are not buying up the government bonds like these dollar-denominated assets like they used to. This is why we have quantitative easing, because we have such huge deficits that we print off way more debt money than the world can possibly absorb or there's demand for. And so what we do is we have our central bank print off dollars to buy the federal government bonds because nobody really wants them. And so that's why you hear about this quantitative easing. And that's all it is. It's just printing off more money because the government can't raise taxes, otherwise the economy would go in the shitter. And it would be very unpopular, and current politicians would not get reelected. But we could go ahead and inflate away our currency by basically printing off money to afford whatever politicians need to bribe the constituencies with. But because the world reserve, we have the world's reserve currency, and the globe is pretty much shittier than us, it will absorb these extra dollars, and we won't see it in our inflation figures. So you kind of see that, like, the inflation rate comes up. Now, what's very interesting is because interest rates are so low, almost even negative in some cases. And I looked them up here. Let me look at here are the federal governments. 1 month is 0.27, 3 month 0.3, 6 month 0.49, 1 year 0.7%, not even 1%. 2 year 0.91, 3 year 1.7, 5 year 1.397, 7 year 1.67, 10 year 1.85, 2 year 2.22, and 30 year government bond is 2.63. Inflation's about 2%, guys. So you're losing money on this. So it's effectively negative interest rates until you get to like the 20 or 30 year, and heaven help you if you have a little bout of inflation. And this is one of the primary concerns. One of the links he linked to the Econ Matters guy. He was talking about what if there's a supply shock in oil. What if there's some kind of disruption that increases inflation on energy and food, which are typically the more volatile components of inflation? And what if it's sustained? So what will happen there is bonds, because their interest rate determines their value, but it's the real interest rate and what other types of interest rates and what's happening to inflation. So if I have a bond that pays 5% and inflation is 1%, well, I'm making a net 4%. That's not too bad in today's economy. If all of a sudden inflation goes up to 10% and it remains there because of an oil embargo like happened in the 70s, or food shortage, or any one of a number of things that can happen to drive prices up, if it's short-lived, okay, oil or energy and food are very volatile. That's why they take it out of the core consumer price index, core inflation. But if it's sustained, all of a sudden the value of these interest payments go down. You're losing money, and then because you're losing money on your interest payments, the price of bonds go down. So even though your interest payments are into the future, you have yet to receive them. If you wanted to sell your bond, someone's going to say your bond only pays 4%. The inflation rate is 7%. In order for me to make any money on that, you've got to lower your price, and that's how you can have a drop in bond prices, even if it's government. Even to say if you're so that is where I think there is a real risk, and I think Econ Matters, the guy over there, he points out a very good point, that is the real risk for anyone who's a bondholder. Now, let's go back to the world of how it should. The question then becomes, when will it burst? And let me give you guys a very important economics lesson. All right, you can all be better economists than all the Federal Reserve economists, all the FDIC economists, all the government academia economists by simply admitting one thing: you don't know. Okay, if you don't know the answer, just admit it, you don't know. And in doing that, you are a better economist than pretty much every doctorate economist out there. We don't know when the bubbles. I don't know when pricing. How do you know when to buy? How do you know when to sell? The answer is Professor Galone, one of the few intelligent people at the Carlson School of Management. He says, I asked him the question. I said, well, how do you know when to sell? He says, if you can answer that, there's some gentleman in New York that'd like to pay you several $1 billion a year to work for him. And he's right. You don't know when it's going to burst. You don't know when the market's going to bottom out, when it's a great price. You don't know when it's time to sell. You don't know when it's time to short. You don't know when it's time to go long. It's impossible to know. Because let's take a relatively short bubble, the dot-com bubble. That was about a 1.5-year bubble, okay? And then one day somebody says, you know what? Until you fucking dot-com start making some fucking money, fuck you. We're not lending you guys any more money on this shit. And then it came crashing down. I think the NASDAQ lost 2/3 of its value. And it crashed quickly. A lengthier bubble would be the housing bubble, which, depending on who you want to cite, that was like a 3-4 year bubble. Starting from about 2003 to 2007 or so. And we were ringing and tolling the sirens like, hey, there's a bubble, and you're just a party pooper. You don't know. You're just a nerd, man. You're a square. You're not a team player. I got a McMansion, and I make $28,000 doing hair at my hair salon. So there's that bullshit, and literally that bullshit. So people, and this is where Alan Greenspan's quote, the market can remain irrational longer than you can remain solvent. Because if you're borrowing money to take these positions in short ETFs or currencies, you got to pay interest on that. And the Federal Reserve can flood the economy with tons of money, keep these bubbles going as long as they want. They will do quantitative easing till the cows come home, and you'll never have your bubble burst. Or at least you'll get a margin call from your broker saying, hey, pay up. And if you ain't got the money, now you file for bankruptcy, right? So, and if you've seen the movie The Big Short, they demonstrate this beautifully. It's a great movie. They demonstrate this beautifully in The Big Short because the guys who are shorting, they're watching the economic data. They're keeping their eye on the economic data. And all of a sudden the economic data comes in and says, oh my God, housing went down, or some economic data showing that the bubble was bursting. Well, home prices kept going up. And the reason why is because they were rational. They didn't care. They wanted the party to go on. And I think it was like 2 to 3 months. And you saw this where, what was his name? Christian Bale's character kept getting calls from these people. I want out. I want out. And he posts the losses. That's how much on paper they were losing. And then he pulled the poison pill saying, I have the right to execute authority and deny you your refunds. And he just waited out the market, and sure enough, the market went down. And I forgot what the total figure was. Like he made 1,000% or whatever like that. So that you see, and that's the nail biting part of it. If you're going to try and short it, so I mean, if you got deep pockets and you have money you can afford to lose, or you got financial backers that have deep pockets, yeah, you could short things for as long. But I don't know who has deeper pockets than the Federal Reserve because they print off the motherfucking money. Can you print off money? No. So that is it's impossible to answer when it's going to burst, and it's kind of too much of a risk to say, oh, I want to short. I'm not a big guy into shorting because when you invest, the worst that it can happen is your investment goes down to zero. So there's a finite loss. If you short, there's no limitation as to how high and thus how much you lose can a stock or a bond or whatever price of any asset go up. So you have unlimited risk. But the real issue is how long can you outlast the Federal Reserve? And the answer is you can't, because the Federal Reserve can print off money till the cows come home, and you have the U.S. military that will basically tell the world to fuck off and suck our dick because they're going to accept the United States dollar. So that's basically it. So is it a bubble? Yes, by all measures, but it's an artificial and controlled market. We don't have free markets anymore in the United States. All right, the stock market is not a market where people go to raise capital. It is a casino, and it's a casino that's controlled by the House, the federal government. Not because it's influencing corporations, and of course there is corruption and bribing and crony capitalism going on. But the chips that we're playing with at this casino, U.S. dollars. That's what the casino is manipulating, and you're just not going to win. You're not going to beat the House. There's just too much political interest. There's too many career politicians' careers at stake, and they don't want to get real jobs and sling coffee. By God, they're Clintons. By God, they're Obamas. They have rich parents that paid for everything. They are better than you and me, and they're not going to dirty their fingers with real labor. So, very lazy, very powerful people who have lots more money than you and I ever do, and are in the are at the controls of the United States Federal Reserve and the levers and levers of the economy. They're not going to let. I mean, now we could still have a financial. We can always have a stock market crash, of course. But I would not be going again. I mean, seriously, go to Vegas, have fun gambling. At least you know you're going to lose, and it's fun. And there's a chance you might win. Go have a poker game with your buddies. Seriously, I mean, if you got I got $1,000, I'm thinking about shorting an ETF. No, go get a Texas Hold'em game together with some buddies of yours, and go bet that money. Or you can usually find a Texas Hold'em tournament if you're in a larger town, and they $20 to buy in or something like that. That's a way more fun time. Yeah, you're gonna stand a higher rate of return. Fucking Janet Yellen or Obama ain't gonna inflate away your money. That's really what I would do. Honestly, I'd play Texas Hold'em before I'd be fucking around with government bonds. So anyway. Hope that helped out. Hope we all learned something. If you have a question or you want a request and you got money, you're going to give it to me, go to assholeconsulting.com. And just so you know, in case Google or the YouTubes decides my free speech is not as free as others, and we have a backup site, Daily Motion. DailyMotion.com/Aaron dash, hyphen or dash, same thing. Aaron dash Clary. Also uploading some of the more key ones over at Facebook. Asshole Consulting has a Facebook page. You can find it at facebook.com/Asshole Consulting. And then Twitter, I couldn't get Asshole Consulting, and it's twitter.com/Asshole Consult. So say hi, go friend face, but more importantly, tell everybody about how fucking awesome I am, telling people the goddamn truth about motherfucking shit and that I charge. We mine truth, that's what we're mining truth. And then we bring it up, and then we get called racist and assholes and mean, and we're very hurtful words, and I say, hey, I was called hurtful words, and there's no fucking way I can work another job. So if you want this truth, you got to pay for it. That's what we specialize in. But yeah, go follow us on the Asshole Consulting and all that. And tell friends. That's the other thing. Tell friends. Best of luck to all of you. Toodles.